Imagine you have a friend who's super into investing, and he decides to help you choose the best companies to earn money from dividends. This friend searches for the companies that pay the best dividends, as if he were putting together a list of the market champions. And that's exactly what DHS does. It chooses the most profitable companies, those that pay good dividends, and puts it all in a single package for you. Now, if you've ever thought about investing in giants like Pfizer, Verizon, Coca-Cola and Cisco, know that DHS does this heavy lifting for you. By investing in it, you don't have to waste time choosing these companies one by one. The ETF already does it for you, like a super financial assistant. And the best? You can still earn dividends every month. It's not like you have to wait 3 months to see a return. What's more, over the past 10 years, those who invested in DHS have seen their money grow, on average 11.57% per year. In other words, if you had invested $10,000 10 years ago, today you would have about $30,000. Not to mention the monthly dividends you receive. Of course, the income of 377%, it's not the highest in the world, but what's cool about DHS is that it combines good returns with the security of investing in solid, reliable companies. Now imagine you have a collection of superhero cards. Each card has a different power, but you want the cards with the least risk, the ones that are least likely to break or lose power. SPHD ETFs works like this. He chooses companies from S&P 500, but only those that have high dividends, and they are less fickle, that is, those that do not usually suffer large falls or ups and downs. This ETF does the work of choosing 51 companies that stand out, such as ExxonMobil and Iron Mountain, and puts them all in one package for you. And the best part, it pays dividends every month, no hassle. If you invest in SPHD, you will not only earn 3.86% dividends per year, as you will also have the comfort of knowing that you are investing in companies stable, which can protect you from major risks in the market. Furthermore, over the years, SPHD has proven itself very solid. Since it was released in 2012, he has had an average return of 11.03% per year. Imagine, if you had put $10,000 there at the beginning, today you would have about $23,000. Isn't it wonderful? And all this without the stress of watching the value of your investment rise and fall endlessly. With a 0.30% administration fee, the cost of maintaining SPHD is quite affordable. It's like having a guide guiding you through the best and safest dividend options on the market. The PGX is a slightly different ETF. Instead of investing in the stocks of ordinary companies, it focuses on preferred shares, which are like a mix of stocks and bonds. The difference is that while common stocks can have more unpredictable profits and losses, preferred stocks offer more stable and higher dividends, like a type of savings account with a more attractive return. This ETF tracks a specific index, the ICE BOF Core Plus Fixed Rate Preferred Securities Index, which basically chooses the best preferred shares of the market, focusing mainly on large banks and financial companies such as Citigroup, JP Morgan and Wells Fargo. With a rate of return of 4.87%, PGX offers a good combination of monthly dividends and controlled risk. Last 10 years, those who invested in PGX saw their money grow by around 6.73% per year, meaning that an initial investment of $10,000 would have become about $19,000. Although it is a little more expensive in terms of administration fee with a 0.52% tax, it offers a good alternative for those looking for passive income with relatively low risk, considering that it invests in preferred shares, which are less volatile than common shares. DIVE, Global X Super Dividend US ETF. The DIVE is an ETF focused on stocks that pay high dividends and that have a low risk profile. He invests in the 50 companies more generous with dividends in USA from big names like Pfizer and Cube Smart. common yield of 5.80% per year, the DIV stands out for paying good dividends monthly, being a great choice for those who want to generate solid passive income. However, what he loses in price appreciation, that is, its market value does not rise as much as other ETFs. It compensates insecurity and predictability of payments. Since it was created in 2013, the DIV had an average annual profitability of 4.67%. An investment of $10,000 at that time, it would have grown to about $16,700, although your 0.45% administration fee a little taller, which really matters for anyone looking for constant cash flow, are the dividends monthly payments he makes. SDIV, Global X Super Dividend ETF. The SDIV is very similar to DIV, but with a more global strategy. Instead of focusing only on the 50 largest dividend payers in the United States, the SDIV spreads throughout the world, investing in companies with the highest dividends from various countries. He is like international party of dividends. Common yield of 6.83% per year, the SDIV pay monthly dividends and has exposure to international markets, such as companies in China, Brazil and South Africa. This global focus increases the profit possibilities, but it also comes with more risk, as these markets can be more volatile than those of the United States. Our last one's 10 years, this DIV had an average profitability of 3.10% per year, which means that an initial investment of $10,000 would have grown to about $1,300 to $600. The administration fee is 0.59%, a little higher than other ETFs, but the great attraction is really the high dividend yield and global diversification. Although capital growth is more modest, the focus of the SDIV is to guarantee a constant source of income, which makes it a good option for those looking for a passive income with a global touch. KBWD, Invesco, KBW High Dividend Yield, Financial ETF. The KBWDS an ETF focused on financial companies to United States, as banks and insurance companies, which pay high dividends. It follows an index called KBW Nasdaq Financial Sector Dividend Yield Index, which selects companies in the financial sector that offer the higher dividend yields. This ETF has a profitability of 7.37% per year, which places it as one of the largest dividend payers from this list. With 41 actions in his portfolio, he focuses on companies that offer financial product show loans, insurance and investments, which gives a more touch specialized to that fund. Although the KBWD have a profitability of 8.75% per year, over the last 10 years, it also presents a higher risk due to the fact that it invests in a sector that is sensitive to factors such as interest rates and economic conditions. Your management index is of 1.24%, which is considerably high compared to other ETFs, and means that for every $10,000 invested, you would pay $124 per year in fees. A main advantage to KBWDIS in your high dividend yield, which can be very attractive to investors looking for constant passive income. However, the risk associated fluctuations in the financial sector and higher administration fees should be considered before making the decision to invest. DHS, Wisdom Tree US High Dividend Fund. The DHS is an ETF focused on shares of American companies that offer high dividends. He invests in companies from sectors such as energy, health, telecommunications, and consumer goods, which have a tradition of paying high dividends to its shareholders. This offers an easier way to invest in stocks that generate passive income, without having to choose the actions individually. This ETF has a profitability of 3.77% per year, which may not be as high as some others on this list, but it compensates with good long-term performance. Last 10 years, the DHS had an average annual return of 11.57%, which means the $10,000 invested 10 years ago would have turned about $30,000. That's quite impressive, considering the consistent return and the high quality of companies in which it invests. Although the DHS have a lower income, yours administration fee is only 38%, making it relatively cheap compared to other ETFs. This means that if you invested $10,000, would only pay $38 per year in fees. Overall, the DHS is an excellent choice for those looking for security and long-term growth, with the advantage of paying monthly dividends, which helps to build a constant passive income. SPHD, Invesco S&P 500, High Dividend, Low Volatility, ETF, the SPHDs, an ETF focused on S&P 500, but with a special approach. He selects only the shares of S&P 500 companies that have very low volatility and high dividends. This means that it is made up of companies that are more stable and less prone to large drops in stock price. It's perfect for anyone who wants dividend yield, common lower risk. This ETF offers a yield of 3.86% per year, which is quite reasonable, and has an average annual profitability of 11.03% since its launch in 2012. If you had invested $10,000 no SPHD in 2012, your investment would have grown to over $23,000. This is great, considering that he stays focused on more stable. The administration fee of the SPHDI is only 0.30%, which means that if you invested $10,000, would only pay $30 per year in management fees, which is very low. This makes the ETF accessible and with a good return potential. The SPHDI is an excellent option for investors looking passive income, but who also want minimize risks, as it focuses on actions with less volatility and bigger security in the long run. The SPEAR SPDR Portfolio S&P 500 High Dividend ETF is one of the most options popular for those who seek invest in shares of large companies and at the same time obtain high dividends. This ETF follows the S&P 500 index, which is made up of the 500 largest companies in the USA. However, SPYD does something a little different. It focuses on S&P 500 stocks who pay higher dividends, that is, it selects them or generous companies in terms of profit distribution. What is the S&P 500 index? The S&P 500 is one of the most indexes following and respected of the financial market. It is composed of 500 largest companies of the USA, covering a wide range of sectors, from technology and energy until health and consumption. These companies are chosen based on their market value, that is, the total value of its shares on the market. The index is a reflection of the performance of the larger and more well-established companies in the country. How does SPYD work? By investing in SPEAR, you are buying a slice of the companies of the S&P 500 that are more focused on paying high dividends. The ETF selects those companies within the index that have the highest dividend yield, which means that it aims companies that distribute a significant portion of their profits to the shareholders. Furthermore, the SPEAR seeks to ensure that this portfolio is well diversified to reduce the risks associated with investing in shares of just one sector or one company. Why choose SPYD? High dividend. The main attraction of the SPEAR is that it focuses on companies that have a history of high dividend payments. With a dividend rate of approximately 4.56% per year, it provides investors with a stable passive income. Ideal for those looking for regular income. Dividends are paid quarterly, which means you can count on a constant inflow of money. Diversification among large companies. SPYD offers diversification in the sense that you are investing in a portfolio composed of robust companies of various sectors of the economy. This helps to mitigate risks if a particular company has financial problems or if a specific sector is underperforming. Instead of investing directly in the shares of a single company, you are acquiring a fraction of 80 to 100 companies, which minimizes the risk of a fall in the price of an individual share. Low administration fee. One of the great attractions of the SPEAR and yours administration fee of only 0.07% per year. This means that for each 10,000 invested, you would only pay 7 annually in maintenance fees. This extremely low fee is one of the reasons why SPYD stands out, especially when compared to other ETFs, high dividend yield, which may have higher rates, investment in solid and consolidated companies. As the SPEAR focuses on companies within the S&P 500 index, you are investing in companies who already have a strong history of stability and growth in the market. These companies have more financial resources, which makes them more capable of maintaining dividend payments, even in times of economic hardship. Therefore, the risk of not receive dividends or see a sharp drop in stock price is smaller compared to more speculative ETFs. Exposure to the financial sector. A significant number of companies that pay high dividends are within the financial sector, including banks, insurance companies, and investment companies. The SPEAR offers a good exposure to this sector, which is known for its profitability and economic resilience. These sectors often do well even during periods of economic uncertainty. What are the risks? Although the SPEAR offers many benefits, there are also risks too. Consider. Focus on high dividend yield. Companies that pay high dividends are not always the best in terms of long-term growth. This is because many of these companies prioritize distributing profits to shareholders rather than reinvesting in the business itself. As a result, these companies may have slower growth, which can affect the stock price over time. Sector concentration risk. Although SPYD is diversified within the S&P 500, it can still be exposed to concentrations within certain sectors, such as financial sector, which is very present among companies that pay high dividends. If the banking sector or financial goes through difficulties, the ETF may be negatively impacted, even if there are other companies in the portfolio. Vulnerability to changes in interest rates. Dividend payments of many companies that SPYD includes may be affected by higher interest rates. When the Central Bank of the United States raises interest rates, companies may have higher debt costs or become less profitable. This can lead to a reduction in dividend payments, directly impacting the ETF's performance. Volatile income. Although the SPEAR have a relatively stable dividend rate, the stock price of the ETF may be more volatile, especially if the stock market in general faces difficulties. The value of shares in companies of high dividend may fall if there are significant changes in economic conditions. SPYD's historical performance, the SPEAR, has proven to be an investment solid over the years, with an average annual profitability of 9.12% we last 5 years. This means that if you had invested $10,005 years ago, today this investment would be worth approximately $15,000. Although the performance of the SPEAR is not as high as that of ETFs that focus on stock growth, it offers a consistent passive income and one good balance between risk and return. Conclusion. The SPEAR, SPDR portfolio, S&P 500, high dividend ETF is an excellent choice for those looking for high dividends with the security and stability of large S&P 500 companies. Your attractive income, low administration fee, and diversified exposure make it a good option for those who want passive income, but without the risk and volatility typical of more speculative investments. If you are interested in a long-term investment that offers a constant cash flow, the SPEAR may be the right choice for your wallet. The VYM, Vanguard High Dividend Yield ETF is a robust choice for investors looking constant passive income without giving up the diversification and of the low administration cost. He invests in a large-cap stock index, prioritizing companies that offer high dividends and have a solid history to distribute profits to shareholders. VYM's strategy is simple yet effective. It follows the FTSE High Dividend Yield Index, which is made up of companies with high dividend yield, mainly in the USA, but with considerable global exposure. This ETF is ideal for those who want to invest in stable, established companies, without the need for detailed analysis of each individual stock. Main features: diversification. VYM offers a wide range of diversification by investing in more than 400 companies, which allows the investor to have exposure to several sectors of the economy, such as healthcare, technology, energy, and consumer goods. Diversification helps minimize risk, as the performance of a single sector or stock doesn't drastically affect the fund's performance. Focus on passive income. The main feature of VYM is its ability to generate passive income through the monthly or quarterly dividends, depending on how the fund distributes. For investors seeking a constant source of money without having to sell your shares, this becomes a significant benefit. Low administration cost. With a rate of administration of only 0.06% per year, VYM stands out from other dividend funds that may charge higher fees, negatively impacting investor profitability. This low cost makes the fund accessible and advantageous, especially for those seeking invest in the long term. Large capitalization companies. The ETF invests predominantly in large companies with a strong presence in the market and a solid cash generation. The companies in VYM's portfolio are well established, which contributes to the stability and fund security. Examples of companies that make up the fund include names such as Johnson & Johnson, Procter & Gamble, Exxon Mobil and Coca-Cola. Growth and profitability potential. Although VYM is not a fund focused on explosive growth, it offers a reliable income and of long term, with an average historical profitability of around 9.5% per year, last 5 years. This profitability is driven by the combination of stock price appreciation and dividends paid regularly to investors. If an investor had invested $10,000 in VYM 5 years ago, today that amount would probably have grown to about $16,000, taking into account the growth in the share price and the dividends paid. However, it is important to highlight that, like any investment, VYM is not without risk. It is subject to market fluctuations and can be impacted by economic factors such as inflation and interest rates. When interest rates rise, for example, the dividend yield may become less attractive compared to investments of fixed income, which can impact the price of the shares that make up VYM. This is a point to consider for those seeking profitability, more stable, especially in times of economic volatility. Exposure to the financial and energy sector. Another important feature to consider is that VYM has a significant exposure to sectors such as finance and energy. This can be a positive point, since companies in these sectors have a tradition of pay high dividends. However, it is also important to keep in mind that these sectors may be more susceptible to economic and political fluctuations. For example, the interest rate could negatively impact banks and other companies in the financial sector, while the energy sector could be affected by changes in oil prices and environmental regulations. Risks, too. VYM, although the background is relatively safe compared to investments of high risk, it is not free from volatility. VYM may be sensitive to market fluctuations and to interest rate dynamics. Furthermore, due to its strategy focused on dividend stocks, it may underperform in markets' strong growth, where the growth equity funds tend to outperform funds' dividends. Furthermore, specific sectors, like the financial and energy, may face moments of economic difficulties that directly impact the fund. However, VYM, by its nature of diversification and focus on large companies with consistent returns, tends to be a better choice, stable and safe than funds with exposure to companies of smaller size or of most volatile sectors. The Vanguard High Dividend Yield ETF is an excellent option for investors looking passive income, diversification and low cost. With a portfolio of large-cap companies, it offers an attractive combination of high dividends and stability. Although it is less aggressive in terms of growth, its consistent profitability over the years combined with low administration costs, makes it a solid option for those looking for constant income and long-term security. However, like any investment, it is essential to understand the risks associated, especially those linked to interest rates and to exposure to specific sectors like the financial and energy. For investors who want security and constant profitability, VYM stands out as an excellent choice.